All right, all right, all right, all right. So everyone in the class, very good morning. Welcome to the session. All right. So everyone, come on. Please confirm if you can see me, hear me. Good morning, everyone. What is the status? Is everything clear? Are you all able to see me, hear me? I turned the advertisements off. Then how come I'm able to see the ads? Anyways, all right. So good morning, everyone. Who all do we have in the live class today? Please say good morning. Shrivastava, good morning. Come on, other live people in the class. So let's get back to the discussion. Aksa, very good morning. Great. So recorded people, welcome to the session. Let's get started. So in the last lecture, we were discussing. Let me open the notes for you. We had to start our discussion from this topic of other important topics, which has all such topics compiled which doesn't belong to any of the valuation methods. Let me also share my screen so that it become visible to you and then we can talk. Perfect. It is now visible. Great. Looks good. Yes, Suradra, very good morning. So what were we saying? Come on, all the live people, all the recorded people. We have to today get started with this category which has other topics which has not fallen into any other category, which doesn't relate to cash flow based valuation, discount, dividend discount valuation, then earnings or asset or relative based valuation. Now we're gonna start with economic value added, right? An extremely easy thing to learn, extremely easy. Yes. So what happens is that, sir, imagine a company doing business. I am a company. When I have to start doing a business, I need capital. So I will take that capital from you. Suppose you are the equity as well as debt. You people are equity as well as debt. So I will get the capital from you. And this capital I would invest in my assets. So me as a company received the amount from you and invested the same amount in my assets in different projects. Economic value added is a very simple concept which says that when I take an amount from you, everyone in the class, live and recorded people, please pay attention, it's extremely easy. When I raise money from you, when I receive the capital from you, it comes to me at a cost. Because on that capital, I have to pay to you some kind of return back. To the equity shareholder, what I have to pay to you is called as K. To the debt holders, what I have to pay to you is called as KD. Or I can say overall, collectively what I have to pay to you people is called my KO, cost of capital, WACC, weighted average cost of capital. Now when I take this amount from you, I invest it in my business. So on that, in that business where I have made the investment, I will be able to generate some return from there. So the profit that I generate from my business is called as operating profit. Yes. So what I generate from my business is EBIT, operating profit. And from that EBIT, I have to pay to you people's like your cost of capital. So the profit which is received from that profit, if I make the payment of cost of capital to you people, then whatever is left with me as a company, whatever is extra left with me, whatever I have generated extra over and above what is to be paid to you is called as economic value added. The excessive amount generated is everyone in the class economic value added. The thing is really simple. The amount that I take from you is capital. And on that capital, what I have to pay is capital charge. That amount when I receive, I invest it to my business, and the return that business give to me is called as NOPAT. Sir, it is the same NOPAT that you had learnt while calculating FCFF. It is EBIT into 1 minus T. That operating profit business will generate to me is EBIT. From that EBIT, if I deduct the tax, I'll get NOPAT. And this is the amount I have with me. From that NOPAT, if I pay to you your capital charges, which means the amount of capital you have given to me minus the weighted average cost of capital. So the capital employed multiplied by WACC give me the capital charge. If that I deduct from NOPAT, the excess left with the company is called as economic value added. More than formula, I want to make you people feel the story, feel the background of the topic. Everyone, could I convey such a simple thing to you? Please confirm. Everyone in the class. Don't look at numbers. Numbers we have not talked about. We have talked about the concepts. We have talked about the story. People, there will be a lot of detailing in it further. But for now, come on everyone, tell me. Yes, is it making sense? Perfect. Sir, now when it comes to calculation, sir, can you please explain why has, again, I don't want to talk about the things which relates to, excessive logics, because we want to focus primarily on exam, right? So on a lighter note, still I would explain to you. You might think that, sir, whatever EBIT I receive from my business, on that entire EBIT I don't have to pay the tax. First I pay interest. After deducting interest, what is left is earnings before tax, profit before tax. And on that amount I have to pay tax. But in your case, you have charged the tax on the entire amount of EBIT. Could you feel the problem? I'm not expecting a solution. I'm just making you people understand the problem. That how can you deduct, sir, directly the entire amount of tax, or how can you deduct tax from the entire amount of EBIT? Do you understand what I said? People. So logic is really simple. Sir, the actual interest, everyone in the class listen to the logic, the actual interest I will pay to you, for example, is 10%. I have raised the money from equity as well as debt. From the debt, the money that I have taken, suppose that is taken at the rate of 10%. I have to pay to you 10%, that is clear. But what am I considering my KD for the purpose of WACC? When I calculate WACC, I need KD, I need KE, I need WD, I need WE. Sir, this KD, will you consider 10% or after tax you will consider it only 7%? Sir, what I actually pay is 10, but what I consider for the purpose of WACC is post-tax cost of debt, which is only 7%. So do you people realize one particular thing? Do you people realize the fact that despite paying in reality 10%, I have to consider an outflow of only 7% in KD used in the calculation of WACC. Which means, do you people agree the advantage of tax on interest, the advantage of tax benefit on interest has already been considered here in the calculation of WACC. So can I reconsider that, can I consider that advantage again in calculation of EBIT? The answer is no. From the EBIT, if you deduct the interest and then charge the tax, which means you are taking the tax benefit of interest, you can't take that benefit twice, here as well as here. Since you have taken that benefit in case of KD, then out here you have to directly apply the entire tax rate. You have to apply the tax rate on the entire amount of EBIT is the point I'm trying to convey. People in the class, please validate if I could explain this particular thing or not. You will have to either, as I say, if you could understand, like the video, I'll get to know that you understood it. However, if you did not, you will have to please ask it in the chat box. I'm ready to explain it again, but the concept should be really clear. Come on. Anuka, very good morning. Come on, come on, come on. All the live, all the recorded people, could you understand what is going on? Yes, fine. Sir, which was the real depth of why do you deduct the tax directly? This is again something which you know. Rarely some people would know in the market, unlike you, why are we directly deducting tax, even if I have the interest component there with me. Chalo, that's really great. Sir, now let's figure out certain things. First, let us talk about calculation of capital employed. Sir, do we have to consider the market value of capital employed or the book value? Logically, I should always consider market value, logically. But Institute unfortunately has created some ambiguities here and there, so we will talk about it. But when I say capital employed, I mean the amount of equity shareholder, the amount of debt, and the amount of preference shareholder, right? These are right now book values. However, if you have the data of market value available with you, you should prefer to use them. Everyone. Second, when it comes to calculation of KE, do you remember CAPM? The logics are really clear. When it comes to calculation of KD, can I say it is generally interest rate into 1 minus T? If interest rate is 10%, then cost of debt we consider is after deducting 30% tax, which is 7%. When it comes to the calculation of WACC, people, when it comes to the calculation of WACC, it is cost of equity into weight of equity plus cost of debt into the weight of debt. Simple. Sir, if the weight of equity and weight of debt are in percentage terms, this formula is fine. What if they are in absolute terms? Meaning to say, someone says that equity weight is 600, debt weight is 900. These are the weights in rupee terms. How do you consider, how do you calculate Q in that case? So we calculate it like, sir, cost of equity into equity divided by equity plus debt, plus cost of debt into debt divided by equity plus debt. So what you are effectively doing here is nothing but calculating the percentage weights only. Please, people in the class, validate if you are clear with such simple calculation of WACC, capital employed or not, because EBIT into 1 minus T is really easy, nothing I have to teach you in that. So if you are settled, we can directly go to the practical questions. Come on. Let me also make you understand one more thing, which is the concept of market value added. People, a small concept, market value added. What it says, sir, when you people give me money, your money in the form of capital, when you all give me money, your money I record in my balance sheet that this is the amount of capital due. That is book value of equity, debt plus preference, book values, right? Equity's book value will include equity share capital, it will include reserve surplus, which means entire equity shareholder fund. Book value of debt and preference share we know. This time we want to calculate as compared to the amount of money you have given, how much is the value of capital, market value of capital in the market. One side is the book value of the capital employed, another side is the market value of capital employed. So we want to check that over and above the book value of capital, which means the amount that he had actually given, as compared to that, how much has now become the market value of the company, because that difference is what has been the market value added by the company. You all gave me 600, but right now my company has the total market value of 1200. Which means, can I say this additional 600 is the value generated by the company for you people, where you did not give me additional 600, you just gave me 6. The cash inflow that came to the company is 6. As per balance sheet, the amount that is payable to you is 6. However, the value of the company right now in the market is 1200. So additional 600 is the market value added by the company. People, are you all understanding this again? These are two extremely easy and basic concepts of economic value added and market value added you have to understand. Any doubt you may all please ask. If no, we go to the practical question. Super ultra fast everyone in the class, please. Come on. Say in the chat box yes or no, settled or not. And also give me a minute. Come on. Great. So, that's all. So, I am now planning to convert this entire batch to the recorded one, because I don't see a point to sit live every day for you guys where I don't feel any that someone is sitting on the other side. Yes. So it may be the case that we might convert this entire batch to the recorded one, or maybe to give live access to the students, not to those who purchase it, but to those who deserve it, right? So I will personally observe, figure out the students they are ready to interact, learn, talk, respond if they are understanding the things or not. If I see that in a student, he will be given an entry to the life, otherwise no. That is the plan I'm thinking of right now. Will that work? Come on. Everyone. What do you all say? Because I never expect you all to compulsorily say yes. I simply expect whatever you feel after learning the topic, please respond if it is yes or no. Do you know how does it feel? To me, how does it feel? Let me show you. This is how it feels. Do you see me? Now imagine you ask me a question that, sir, is economic value added an important concept for exam? Suppose you are asking me this question that, sir, an economic value added, is it an important question in exam? And I am responding like this. Could you understand my response? Come on, tell me, could you understand my response? But I have responded for your knowledge. I nodded my head. In my brain, I responded. In fact, I nodded my head. Yes. You all can see my face, I cannot see your face. What your exact feeling, understanding of the things is, that's only here in this chat. Which is why I don't ask you to write down much. A simple yes or no helps me to understand how much I should be, and that's because of my concern. I always had a choice to record the lecture and sell it to you. In which case I don't have to be concerned about are you understanding it or not. But now when we sit live, I have this concern, which is why I ask you multiple times for every topic, is it 10 on 10 or not? Because if it is not, I will put in that effort again to make sure it goes 10 on 10. Which is why this expectation particularly that you will reply back. Yeah. So great, if the concept of economic value added is really clear, we are now moving ahead to the practical questions. First practical question that we want to do is question number 70 that you do at home. Easy, basic, good question, 70th economic value added. The next question that one second. The next question is question number 71, which also you do in homework, C part of which you don't need to do. Part C of this question you don't need to do. In fact, let's do this. So let me make you people do 71 question in the class itself. Come on. Shall we proceed? Sir, Delta Limited's current financial year income statement reports its net income of 15 lakh. There is this company whose net income is 15 lakh rupees. Delta's marginal tax rate is 40%. The company's tax rate is 40% and its interest expense for the year was 15 lakhs. Come on. Company paid interest, company paid tax, and after making all these payments, the profit is 15 lakhs. Sir, the company has 1 crore rupee of invested capital, of which 60% of debt. In addition, Delta tries to maintain a weighted average cost of capital of 12.6%. Company has the total capital employed, which has 60% debt, which means 40% equity, and also company has the weighted average cost of capital of 12.6%. Compute the operating income or EBIT earned by Delta Limited in the current year. At present, how much is the operating income or EBIT earned by the company? Classwork challenge. I give you just a minute or 2 minutes to answer first question. I have been given the net income. I need to calculate EBIT. Everyone in the class do it live. Come on. Recorded people, take out your calcies, do calculate it and keep the answer ready. I will say it and you have to confirm. Validate. Come on. Aksa says it is 9 lakhs of EBIT. Is it? Sir, what have we been given? PAT. So EBIT minus interest is PBT, minus tax is PAT. If PAT is equal to 15 lakhs given to me, and I know due to 40% tax rate, PAT is equal to 60% because 40% tax has been deducted. So what would have been the 100% amount, which is PBT? Sir, 15 lakhs divided by 60% give me 25 lakhs as my PBT. Because of 25 lakhs, 40% when you deduct, 9 lakhs when you deduct, you are left with, 10 lakhs when you deduct, you are left with 15 lakhs as your PAT. And interest, sir, if has been 15 lakhs, then EBIT would have been 40 lakhs because EBIT minus interest was PBT. Settled? Are we all? Come on. Yes. So 40 lakhs is the amount of EBIT, an easy one. The next one is they are asking you to compute delta. Compute delta's economic value added. So economic value added is really simple. That, sir, the EBIT I have earned is this. Let me convert this EBIT into NOPAT, which is 40 lakhs into 1 minus 40% directly. This is the NOPAT company has earned. From that earned NOPAT, how much company needs to distribute to you people is 1 crore rupee into 12.6%. So 40 lakhs into 60% M plus 1 crore into 12.6% M minus, memory recollect is 11 lakhs 40,000 as your economic value added. Part B of this question has also been answered. Settled are you all? Easy, basic. Third part. Delta has 2,50,000 equity shares outstanding. According to economic value added, you computed in second how much Delta pay in dividend per share before value of the company would start to decrease. This part require some addition. See, the solution to this part is easy, but the thought process is a bit difficult. Solution is easy, thought process is a bit difficult. I would try to explain the thought process on a lighter note. For a single question whose chances are not very much, let's not make intensive efforts to understand that particular thing. The logic is really easy. What the logic on a lighter note want to say is that today, how much extra value company has over and above your expectation? In the WACC of 12.6, expectation of equity and debt has been considered, which means after deducting on an amount of 1 crore rupees after deducting 12.6%, which means your expectation has been deducted and after that company is left with 11,40,000 of extra profit. Correct? This 11 lakh extra 40,000 extra profit belongs to who? Sir, ultimately the residual claim in the company belongs to equity. Whatever is left in the company will belong to equity. Sir, this extra which company has, if company wants to distribute to the investor, it can distribute in the form of dividends. If it wants to distribute to the equity shareholder, so this amount of 1140 divided by 2,50,000 shares that company has, give me on a per share basis how much is the excess amount company could earn in this year. 4.56 rupee, 11,40,000 divided by 2,50,000 is 4.56 rupee is what? This is what company can distribute on a per share basis extra over and above their expectation of 12.6%. So question was, to what extent can the company distribute the dividend? Sir, to this extent. Question was saying what was the extent beyond which if we distribute, price of the company will start to fall. So we will say that 4.56 rupee on a per share basis company has earned extra over and above their expectation. This much we can distribute. However, if we distribute beyond it, which means beyond it the cash from the company will go out, and that particular cash when go out, which was not extra cash, it was within the expectation of the shareholder, it was within that expectation of 12.6. When that cash go out of the company, the share price will start to fall. When we distribute 4.56, it is anyways the excess cash earned by the company. That you distribute won't affect the share price. But beyond that, if you distribute companies, this thing, share price will decrease. Could you understand, people? The text is not written that I was trying to explain, that was just the explanation. You all need to please validate. Could you understand this particular point or not? Come on. Akshay, yes. Other live and recorded people, come on. Clear. So we have done this particular question 71. There is another similar nature question 72 that you need to solve at home, but that too only on the calci. Not only on the calci, not in the notebook. Then is question number 73 is really a good question, but you can do this question only after the chapter of portfolio management, right? So one thing we can do is that I will make you people do this question in the class, but if you are able to remind to me of this question after the chapter of portfolio management is done. In the chapter of portfolio management, we will learn something called as levered beta versus unlevered beta. Levered beta versus unlevered beta, that concept has been used. So after the chapter of portfolio management is done, you remind to me, we will do this question 73 in class. 74, easy and challenge question. What is this concept of challenge question, sir? Let me explain to you. Although it's very late in our class to introduce such concept, very late. You know what? The batches generally that we have every time is extremely interactive, to whom I also give classwork challenge and homework challenge. I say that if you really want to test if you have learnt the things or not, if you really want to test if you have evolved or not, let me give to you certain questions which are tricky in nature. Normal questions you are able to do, but what if you face a tricky question in the exam? Sir, that is one such tricky question Institute asked in the exam of November 24. If you are able to do this question at home, it gives you a confidence that if I am able to do it at home, then obviously I'll be able to do it in the exam. However, if you are not able to do it at home only, then you have to realize that it means I will have to put extra efforts, more revisions, further thought process further the thought process is needed to be evolved for me to be able to answer such questions. So, how many of you are at least strong enough? How many of you are strong enough at least to accept the challenge? Forget completing or not. But how many of you think that, sir, we will put in our extra efforts, we are ready to spend even half an hour to make sure that we are able to solve this question somehow? Do you have that mindset? And I'm not expecting that you go home and this is the first question you do know. You go home, you revise the concept of economic value added, you solve all other questions, classwork, homework, and after you are done with everything, then proceed to solve this question. And then if you are able to, and then it will be, that's how, in fact, I can say the confidence is built. Your confidence can be built in two ways. One, through my motivational words. That will be a fake confidence, an outer layer of confidence which won't continue for very long. Another way to build the confidence is from within, from your core, and that will happen through these challenge question solving. Because when you solve it, your brain and your body knows that I can do it and have done it. That's inner confidence that will remain till exam. Otherwise, if I do some motivation, you will feel confident but temporarily. Do you agree to what I'm saying? How many times in your life have you heard those external motivation videos? Motivational quotes? So many times. But that was all external. When it comes from within, it's forever. And from within, for you to come, you will have to make those efforts that I want to make you people do, and I'm making those arrangements that you do it. Done? So 74th question, challenge everyone. Let's figure out if you are able to do it or not. 75th question, let's do in the class. Good question of tricky nature. Make uses of this formula called as financial leverage. Yes. So let me explain to you what this concept is, people in the class. So what happens is that when I look at the formula of degree of financial leverage, how many of you remember reading it CA interlevel, something called as degree of financial leverage, people? If you prepare the income statement, you take EBIT minus interest is equal to PBT. Basically, you have to compare two numbers. Financial leverage, the word leverage relates to debt. One second. The word financial leverage relates to debt. And in my income statement, the relevant word is interest. So you have to compare two numbers. One number before interest, one number after interest to understand the effect of interest. So basically when I do EBIT divided by profit before tax, I want to check how much is my EBIT as compared to PBT, because whatever has been reduced is on account of interest. This formula is called as degree of financial leverage. The word financial leverage is something else, and the word out here is degree of financial leverage. The unfortunate part is that The unfortunate part is that in this question 75, Institute has made an ambiguity. Institute says financial leverage is 1.5 times. The formula of financial leverage is equity, or I can say the formula of financial leverage is assets divided by debt, assets divided by equity. Sorry. You don't have to apply the formula of financial leverage. This is an ambiguity. What you have to actually apply is the formula of degree of financial leverage. One second. What is the formula of degree of financial leverage? Sir, it is EBIT minus divided by PBT. Sir, is it something we will have to remember? Yes, kind of. I realize that most of the questions, most of the students who are attending this batch, not as a first timer, which means who have at some point done some batch of AFM, would have seen this question. But a very few of you would have observed that financial leverage and degree of financial leverage are two different things. I remember as a student, this is an older question, even I was as a student not being taught that, sir, financial leverage is something, it relates to balance sheet. Degree of financial leverage is something which relates to income statement, and that is what we want to use in the solution of this question. Yes, so let us proceed. With the help of following information Jatayu Limited, compute economic value added. You have to compute economic value added. What all has been given to us? Capital structure has been given. Equity capital is 160 lakhs, reserves and surplus is 140 lakhs, 10% debenture is 400 lakhs. Capital structure of the company has been given. Cost of equity has been 14%, financial leverage is 1.5 times, and income tax rate is 30%. You have to compute economic value added. I want to give you 2 minutes, everyone. It's a classwork challenge that you figure out at your own that, okay, for economic value added, what all do I need and what all do I have. I'm trying to teach to you how should you approach a new question. Take your time. First you'll figure out for economic value added, what do you need? Then you figure out of those, what all do you have? And then we think ahead. Come on. Come on, come on, come on, people. Give me a minute, everyone. Let me have water, please. Could you think? Come on. Could you all think? See, I don't expect that you'll be able to solve all such questions right from day one. But I can expect that you all make those efforts at least right from day one. Sir, we realize that to calculate economic value added, we need 2-3 things. First, we need EBIT. To that, I multiply 1 minus T. From that, I need to deduct my capital charged, which is nothing but capital employed multiplied by WACC. So let's figure out one by one what all do we have. So do I have EBIT into 1 minus T? I don't see it anywhere directly. Although 1 minus T, which is 1 minus 30%, is there with me, but the amount of EBIT, I don't see it clearly. Fine. Do I have the capital employed, sir? Yes, 160 plus 140 is 300 plus 400 is 700. So minus 700 into, do I have the amount of WACC with me, weighted average cost of capital? Sir, directly not given to me, but I can calculate it as KE, KD, WD, WE. Cost of equity is 14. Fine. Weight of equity is 300 divided by 700. Weight of equity is 300 divided by 700. Cost of debt. Interest is 10%, tax rate is 30, so cost of debt is 7%. And weight of equity, people in the class, is how much? Weight of debt is how much? 400 divided by 700. So 14% KE, weight is 300 by 700. 7% KD, weight is 400 divided by 700. Let's first of all calculate the WACC. 14 into 300 divided by 700 M plus, and 7 into 400 divided by 700 M plus. Memory recollect to give me 10% as my weighted average cost of capital. So I have capital employed of 700 multiplied by 10% as my WACC, right? I have tax rate available with me. The only number that I need is EBIT. People in the class, are you aligned to this explanation that I have made? Come on, please super ultra fast respond. What do you all say? Everyone. Are you all aligned to the explanation that I've made? Now go back to the question and figure out that which data point can help me calculate my EBIT. Can income tax rate do it? Not directly. KE? No sir. Capital structure? No. The only thing which is left to you is financial leverage. Although financial leverage is actually assets divided by equity, but unfortunately examiner has used the word financial leverage, but what it has actually done is degree of financial leverage. Institute say 1.5 times the degree of financial leverage, which means EBIT divided by EBT is equal to 1.5. My EBIT as compared to EBT is 1.5 times. Can I say, sir, EBT is nothing but EBIT minus interest? EBIT divided by EBIT minus interest is 1.5 times. Sir, how much is the amount of interest? 400 lakhs into 10%, 40 lakhs is the amount of interest. So 1.5 is equal to EBIT divided by EBIT minus 40 lakhs. If this entire equation you solve, what do you get? You get the amount of EBIT. Can you all please try to solve this equation in the class right now? EBIT divided by EBIT minus 40 is equal to 1.5. Solve this equation and give me the answer. Come on. Come on, come on, come on. EBIT. So if we solve it, the amount of EBIT becomes, 1 minute, let me check. The amount of EBIT becomes, everyone in the class, EBIT into 1.5 minus EBIT is 0.5. 0.5 divided by 60 divided by 0.5 is how much? 120. People in the class is the amount of EBIT if you solve it. So now I have 120 as my EBIT. I have 30% tax rate. I have capital employed of 700. I have WACC of 10%. Can I directly have the economic value added now? The answer is yes. 120 into 70% M plus 700 into 10% M minus memory recollect of 14 gives me the answer of economic value added. 14 lakhs is the answer of economic value added. People, please tell me how much out of 10 are you please settled with this particular question. Come on, come on, come on. Look at the calculation here. When you take this entire amount here to the left, it becomes 1.5 EBIT minus 60. 1.5 EBIT is here towards LHS. In the RHS, I have EBIT. When I bring it to LHS, it becomes 1.5 EBIT minus EBIT is equal to 60. So EBIT is equal to 60 divided by 0.5, which is nothing but, everyone, 120. Others requesting your responses, please. Question 75th gets done. 76th is another question. But I am thinking '76th is the actual level of question which I can say should be a challenge. This is such a challenge question that I don't even expect that you will be able to do it. Small but a tricky one. Only the students who has understanding of economic value added over and above formula will be able to answer this question. I am not expecting that you all are able to complete it, but I am expecting you all try it. Will you please also try? There's a small question 76th at home. Please speak up. Come on. Which means if you are able to solve it, then all the live and recorded people, it means that you've gone beyond my expectations. 76th, everyone has homework. Remind to me of it tomorrow. We'll discuss it once very quickly. 77th is a homework question. 78th is a homework question. The problem with these two questions, especially the 77th, let's do it in the 77th is homework, 78 let's do classwork. The problem with question 77 is that it is extremely vague. Examiner has given government bond rate. Sir, government bond rate is actually risk-free rate, but that's assumed as KD. Examiner has given bond portfolio return. Has no logic, but it is assumed as KE. So with this randomness, this question is there, but since is a part of a study material and has been asked sometimes in exam, we will have to do this question as it is. It is easy, very easy, but ambiguous with respect to the rates especially. The ambiguity has been returned for your reference out here. Done everyone? Then is anyways, then is question number 78, another question from study material that we will do at home in the class right now. Are we all set? Question number 78. Very immediately, let us proceed. We have to calculate the economic value added using given information. What all information do we have? We have the information of property, plant, equipment. We have the information of current assets from the asset side. Liability side at equity reserve, non-current borrowing, current liabilities. This is the entire balance sheet. Then profit loss account, revenue minus cost minus selling admin general expense, which give me EBIT, minus interest is EBIT, minus tax is profit after tax. Now this is the actual point of learning in this question. This point of learning says what? Let me show that to you in the concepts notes. This particular note relate to question 78 that we were solving. If there is any non-cash expense other than depreciation, depreciation is primarily operating in nature. Other than depreciation, if there is a non-cash expense, then it will have to be added back to EBIT while calculating NOPAT. In economic value added, you need NOPAT, right? How is NOPAT calculated? EBIT into 1 minus T. So the non-cash expense will be added back, which was being deducted in the calculation of EBIT. We want to reverse the effect of non-cash expense is my point. Yes. So examiner says, assume bedded provision of rupees 20 lakhs is included in SG&A. Selling general and admin expense has amount of 20 lakhs included, which obviously means that, sir, while calculating EBIT, this amount has been deducted and same amount is reduced from the trade receivable in current asset. The same amount got reduced. Okay, give me a second, please. 1 second. I feel Yes. So examiner says there is this non-cash expense. People, are you all there? Back please, listen to me. There is this non-cash expense of rupees 20 lakhs. Right? This expense has been deducted in this heading of selling, admin and general expense. Also, the same amount is reduced from trade receivable. Sir, you all think naturally, what is the effect of provision for doubtful debt, provision for bad debt? Sir, you all naturally deducted from the current asset. So expenses booked here, that is first effect. Then trade receivables are deducted, that is second effect in the balance sheet. Also assume pre-tax cost of debt is 12%, tax rate is 30%, cost of equity is 8.45%. Yes, you have to calculate economic value added. So let's start our discussion with NOPAT. First thing, you have to add back 20 lakhs, right? So when I ask you to add back 20 lakhs or when institute asks me to add back 20 lakhs, what do I feel? I feel that to the amount of EBIT, which is 410, listen to me everyone in the class, I should first add back 20 to make it 430. And then from this EBIT I have to multiply 1 minus t. To that EBIT I have to multiply 1 minus t. This is what I feel, right? But what has institute done is something else. What they did is at 410 is the amount of EBIT. From that EBIT they have first deducted the tax to make it NOPAT. To that NOPAT they have added back the non-cash expense of rupee 20. So 410 minus 30% plus 20 is 307 as my NOPAT. So this is something you will have to specifically remember. I would request all the students not to feel very troubled about ambiguities. This is the first chapter which has most of the ambiguities. Now the chapters that we will face ahead won't have so many ambiguities, first thing. And second and more important things, out of all the questions that you do, not more than 1 or 2 questions, generally seeing, not more than 1 or 2 questions will have ambiguity. You must be wondering, sir, 2 questions are not less. They are important enough for us to decide whether we are getting pass or fail in the exam. I agree to it. But 2 things. First, this is the ambiguity not just you will face, entire India will face. And second, out of those 2 ambiguous questions, not necessary that you won't be able to do any. You may be able to recollect certain things, like in this particular question, that okay, I will have to first deduct the tax and then add back the amount rather than adding the amount and then deducting the tax, right? There is no other way for such ambiguous questions other than to kind of remember them. Yes, so back to it. No option, I mean to say, you don't have any option. So 307 is the amount of NOPAT. So NOPAT is there. Now I need to talk about the capital employed. Sir, equity is there, reserve is there. Now again, can I say the amount of equity become 800 and amount of debt become 100? So capital employed become 100 plus 800. 800 plus 100. Now there is one more ambiguity. First let me explain to you the logic, then the ambiguity. Sir, if I add back 10 rupee, if I add back 20 rupees to selling general and admin expense, 20 rupee of doubtful debt, then my sir profit will also increase. And ultimately my retained earning will also increase by 20. It's not 100% correct, but the initial logic or the thought process is correct. When the expense reduces, profit increases. Due to increase in profit, ultimately my retained earning will also increase. So retained earning will become 120. So that's how we say 700 equity reserves of 120, non-current borrowing of 100 and capital employed of 920, which looks, semi-logical. Why semi-logical? Because sir, one thing which institute missed to realize is that if we increase the expense, if we decrease the expense by 20, then my profit will increase by 20, and on that increased profit I will have to also pay increased tax. So if my profit increased by 20, 20 into 30% is 6 rupee will be the increase in tax, and net increase to the net profit will be only 14 rupees. Could you understand, everyone in the class, the point I'm trying to make? So in a sense it is good that institute has missed that point, which is why the solution look easy to us. I can directly add to the reserves an amount of rupee 20, which institute missed to realize that it should be after the effect of tax. So 700 plus 20 plus 100 is the total capital employed. Then is another ambiguity, where in the calculation of WACC, if cost of equity is 8.45, which is fine, the weight of equity, everyone in the class, should be 820 divided by 920 if you realize. According to them, the weight of equity should be 820 divided by 920. And weight of debt should be 100 divided by 920, which is what institute actually missed. What it missed? It ignored this 20 and considered the weight based on 800 and 100 only, which is the mistake institute has made. The history of this question is really different. Once it was, very first it was introduced in May 2018's study material. Somewhere in May 2018 or Jan 2018, institute came up with its study material of new course where this question was introduced. There this question had further ambiguities. In the coming editions, this question got rectified. Some ambiguities were eliminated, but still there are certain ambiguities that I spoke about. With those ambiguities, we will have to do this question as it is. So 920 is my capital employed, but unfortunately the WACC is based on 900 of capital employed. And now ultimately economic value added. Now PAT is 307 minus capital employed multiplied by WACC, 920 multiplied by 8.77, 8.44, 8.44%. When you deduct it from 307, we get 229.35 lakhs as the economic value added. People, please confirm if I could explain first the logic and second the ambiguities of this particular question 78. Waiting for your responses. Come on, tell me. So, Anuka, is that true? Are you all? Sorted. So I first of all feel bad that unfortunately there are so many ambiguous questions, but please trust me, when you revise them, most of the ambiguous question you will find yourself comfortable with. This is, in fact, I don't have a choice. I have my own limitations to teach the things to you in the manner which will secure you marks rather than to teach to you what is logical. Okay, 78th gets done, 79th you won't have to do, 79th question you don't do 79th, 80th question you may do, you may not do, choice is yours, 80th. Fine. So now we have completed the entire discussion on economic value added. On market value added, we had one or two questions which have gone to you in the form of homework, and this entire discussion along with concepts and question on economic value added and market value added gets done. We now come to the next concept, the name of which is rights issue. People, the rights issue. How many of you know what rights issue are? Come on, everyone in the class. How many of you know what are rights issue? Do you recollect any of this thing from your previous learning of CA final or maybe CA inter? Companies Act, also in inter-accounting. Sir, I am a company. You are my shareholder. I have already raised money from you, which is why you are my shareholder. If I need more money, I can either take debt from the market, fine. I can issue my debentures in the market, fine. What if I want to raise the money by way of equity shares? I can further issue my equity shares in the market. But please realize the problem, if I issue the equity shares in the market, then your ownership will get diluted. Right now I have 10 shares raised, issued to you people. If I need more money, I will issue 10 more shares to someone else in the market, and in that case your ownership will be left with only 50%. You won't be owning the company 100%, you will have the limited ownership. Correct? Which is why I came up with this solution that I want to raise money, I will issue the equity shares. But it will be primarily issued to you. You will be given the option to first buy the share of a company at a lower price. You have a choice that price of the share in the market is 100. But I give you a choice that if you want, you can buy my share for 80 rupees. If you buy, well and good. If you don't buy, you can sell this option to anyone else as well. For example, I give you this offer that you can buy my share for 80 rupees. First of all, if you buy, I will give you the share, you give me 80 rupees. As a company, my thing is done. I needed capital, I have received it. If you don't want to buy it, you can sell that option to your friend. You can sell it to your friend saying that, see, there is this share in the market of 100 rupees. The same share you can buy for 80, and this option you are selling it to your friend saying that now my friend, even you can, my friend, now you will be able to buy that share of 100 for rupee 80. This option that you get, this right that you get can be transferred to your friend if you want. However, if you don't transfer, if you yourself buy it, then it become, it's the easiest thing which can happen. So that is a right issue where an existing shareholder get a right. It's not a compulsion, it's not a foundation, it's a right, it's an option to buy the share of a company at a price which is lower than market, right? So right is an option. The share that I will allot to you under this option are called as right shares. This entire process of issuing the shares to you is called as rights issue. It's basically the process of raising fund by issuing the shares through right is called as right issue, right? Now there is one more terminology in this, which is the concept of rights ratio. I have lakhs of shareholders with me. How do I figure out, people? I have lakhs of shareholders with me. How do I figure out that How many shares should be allotted to which all shareholder? The best way to deal with is rights ratio. For example, my company already has 10,000 shares and the company wants to issue 2,000 shares more. The company wants to issue 2,000 shares more. So in that case, can I say against 2,000, against 10,000, if the company wants to issue 2,000 shares, it is as good as against 5 company wants to issue 1 share. So this becomes the right ratio where every given shareholder will be given a choice that against every 5 share that you hold, you will be given 1 more share of the company. Against every 5 share that you hold, you will be given an option to buy 1 more share of the company at a lower price of 80 rupees, where the price per share in the market is 100. This option, if you want, you can exercise, and the ratio that is decided by the company is called as rights ratio. Could I explain that right is an option? The share that you will be issued to you under this option are right shares. The ratio in which the rights will be offered to you is rights ratio. You can either exercise the right, which means buy the share at a lower price. You can either renounce the right, which means sell that option to your friend that he can buy at a lower price, and you can ignore the right the way you are ignoring to me, everyone in the class, when I ask you to reply. Yes. Sir, ignore the right, which means I give you a chance that you can buy the share of the company for 80 rupees. Neither you buy it nor you sell it to your friend. You just ignore it. That is the third option. Sir, in this entire process, what are we supposed to calculate? Well, that was a joke, everyone. Don't take it as a taunt. Take it as a joke, that which I told you regarding ignoring me. Well, Sonuka, your answer is absolutely correct. That is nothing but the option given to the existing shareholder. Perfect. So come on, just give me a minute. Yes, so now let me tell you what is institute expecting us to solve. Institute is saying that company before the right issue already has a price. Yes, we call it pre-right price. It already has a price of 100 rupee in the market. Cool. At the point of right issue, company is issuing the share to the shareholder at a price of 100, at a price of 80, sorry. At a price of 80, company is issuing new shares. So after these rights shares are issued, immediately after this point, will the price of the shares will change from 100 to something? Or will it be same as 100? Sir, ideally they should change, because the price that already is there is 100. Now in that 100, we are mixing the shares which are issued at a price of 80. So it should affect the existing price of 100. So the price that will prevail immediately after the issue is called as post-right price. And that is what we are needed to calculate in this situation, in this topic. So let us take this example, and extremely easy, because this example will also solve the purpose of question. Yes, for example, suppose the pre-write price in the market, which I am calling as P0, is 100. The pre-write price is 100. The pre-write number of share, which I am calling as N0, suppose are 1000. So I have 1000 shares of 100 each. Now out of the other three information, company will give you any two. Which three information? Let me tell you. Suppose company needs 20,000 rupee to start a new project. Price of share in the market is 100. So company thinks to issue. Company is thinking to issue the share at a price of 80. So 20,000 divided by 80, everyone in the class, gives me 250 shares to be issued. 250 shares to be issued by the company in the form of right shares. Which brings to me what ratio? Sir, 250 are to be issued against existing share of 1000, which means the ratio which turns out to be is 1:4. The point I want to convey to you, everyone in the class, is out of these three information, any two information will be given. First information, the amount to be raised. Second information, the rights ratio, or the third information, issue price. So we will surely have the data of existing setup, existing price and number of share, and regarding the new things, the right issue, we will have this information. What I need to calculate is that immediately after the right issue, what will be the post-right price. To be able to do that calculation, everyone, listen to me. To be able to do that calculation, first of all, we should have these two numbers with us. Number one, what is the price at which share will be issued? 80 rupees. And how many number of shares will be issued? Sir, that is 250 shares. These two data we must be able to calculate first from whatever data is given, because without the data we cannot proceed. Yes? So let us understand it. Yes, come on. Sir, if the examiner give me these two numbers, it gives me 20,000, the amount to be raised, and 1:4 as the rights ratio. How do I calculate the issue price and the number of shares to be issued out of it? Really easy. I know my existing shares are 1000. If the ratio of 1:4 is applied to it, I get 250 shares to be issued. This thing is clear. And if I know that the total amount to be raised is 20,000, and that will be raised by way of 250 shares, so 20,000 divided by 250 give me, everyone in the class, 20,000 divided by 250 gives me 80 rupees as my share price. Yes or no? Issue price. Yes. Sir, what if institute give me this and this? So 80 of issue price has directly been given, 1:4 is given, so I can calculate 1000 into 1/4 as 250 being the number of shares. What if institute give you this and this? Again easy. Issue price directly given. 20,000 divided by 80. 20,000 is the amount to be raised, where per share will give me 80 rupees. So I need to issue 250 shares, which means whatever be the information given, I should be able to calculate N1 and P1, case 1, case 2 and case 3. All three possible cases we have discussed out here. Then now the way to calculate. The logic to calculate, everyone in the class, is extremely easy. Extremely easy. What is the logic? Logic is really simple. The logic is simple. If I want to calculate the market price immediately after rights issue, I need to first have the market value immediately after right issue, and I need to have the number of share immediately after right issue. Because market value divided by number of share will give me the market price. If I need the market price after right, I should have the market value and the number of share after rights. Correct? Agreeing to it? Fine. Can I say the market value after right will be really easy? It will the market value before right plus the market value which got increased due to rights. Sir, how will my market value increase due to the rights? When I issue those 250 shares to you, you are going to give me 20,000. So 20,000 is the amount of cash that will increase by in the company. And can I say by the same amount, value of company will also increase? So increase in the value of the company will be equal to the subscription amount that you have raised, which is 20,000 in our case. So the logic of X right price, if you understand, is really simple. Sir, X right price is X right market value X right price divided by X right price. X right market value is the pre-right market value plus the subscription amount raised. And X right number of share is again on the same logic, pre-right number of share plus the number of shares issued under rights. And the formula now is pre-right market value is simple. Sir, I had 1000 shares of 100 each. Subscription amount raised is again simple. I have issued 250 shares of 80 each. So 1000 share of 100 each, 250 share of 80 each will give me the revised market value, post-right market value. Divided by how many number of shares do I have now? Sir, I already had 1000 shares. I issued 250 more. With this, can you all please calculate what is going to be the price immediately after rights? Come on, everyone in the class, use your calci. Come on. How do you calculate it? So really simple. 100 multiplied by 1000 m plus 80 multiplied by 250 m plus memory recollect divided by 1250 give me 96 as my X right price. Which means price of 100 is already there in the market. To that, if I add the price of 80, 100 price 1000 shares are there. If I issue 80 price 250 share, it become 96 price 1250 shares. That's simple if you realize, everyone, the thing is. 1 second. Yes, perfect. Sir, after calculating the X right price, the next thing that you have to calculate is again easy. Sir, what is the value of right alone? What is the value of that option alone? The share which was trading at rupees 100, you know that after the right issue, it will trade at 96. First of all, let's make it logically clear what is your benefit. The share which is right now trading in the market at 100, you know that after a point it will trade at 96. Agreed. The same share before the issue we stand, right before the issue we stand here and we see that the same share which will trade at rupees 96 after a day, I can buy that share for rupees 80 today. Do you realize it? The same share which will trade at 96 tomorrow, that I can buy at 80 today. Can you feel the advantage of rupees 16 that you can have, people? So you have a choice. Either you buy that share, or if you don't want to buy it, if you don't want to exercise this right option, you can sell that option to your friend. The question is, what is the price at which you will sell it? The common sense is really simple. Your friend will be ready to pay to you an amount that is equal to the benefit he gets. How much benefit is he getting? Let us try to understand. Do you agree it is the same benefit of 16 rupees he will get? What is he thinking? What is your friend thinking? The friend is thinking that the share which will become 96 tomorrow can today be purchased by him at a price of 80, which means with this scheme he is going to get 16 rupee benefit. So when you sell this option to him, how much maximum price will he be ready to pay to you? Sir, obviously the same amount of rupees 16, not more than that. I don't want to convert it to formula, but I want to make you people understand the common sense. 96 is the price that it will become tomorrow, X right price, and 80 is the issue price at which he can buy the share today. 16 is value per right. Now let's take it a step ahead. Sir, what is the value of right on a per share basis? Do you agree that when you sell that right to him, you will receive 16 rupee? This 16 rupee of benefit that you have received is against one right. And how did you get that one right? Sir, since you were holding 4 share against 4 share, you got a right to buy 1 share. So can I say this 16 rupee of advantage you earned is against the 4 share that you were holding? Which means in one particular share, how much is the advantage of right? Sir, it is 16. One second. In one particular share, how much is the advantage of right? Sir, 16 rupees the benefit you will receive against 4 share that you are holding. Then in one particular share, it is 4 rupee of advantage of right which is incorporated. Everyone, could you understand what I just said, people? The 16 rupee and 4 rupee, could you understand? That my 4 share you were holding already, which is why you got 1 right, and that 1 right is sold for 16 rupee. So in 1 share that you hold of mine, how much is the value of right incorporated into it? It is 4 rupee. Please validate. Agreement, disagreement, what do you say? People, please validate. Could you understand it or not? Yes. So institute first expect you to learn to calculate the X right price. Then institute expect you to learn the value of right alone. Then at last it expect you to learn if there is a gain or loss to the shareholder on account of this transaction. Even that is really simple. So let's learn it. For example, imagine that I am a shareholder having 100 shares. What is the price per share? 100 only. So 100 shares of 100 each give me 10,000 rupee of wealth that I have before the rights. Suppose the company announces rights 1:480 rupees issue price, everything same. I have 3 choice: subscribe it, renounce it, ignore it. What if I subscribe it? Sir, against 100 share, how many rights I must have received? Sir, 25. If you subscribe to it, do you agree your wealth will become 125 shares? But the price per share in the market has become now 96. So 125 share multiplied by 96 give me 12,000 as my wealth in terms of shares. Agreed? So sorry for this background disturbance. Actually, some construction is going on, as I said yesterday, which is not in my hand. So 125 shares at a price of 96, because now the price has become 96, give me 12,000 rupee of wealth. I am trying to calculate pre-write how much is the wealth, post-write after the rights are being issued how much is my wealth. Sir, these 25 shares that you purchased, you must have paid some cash for it. Yes sir, the cash has gone out on 25 share at a price of rupee 80. So 25 multiplied by 80 is the amount of 2000 rupee of cash that has gone out. So 12,000 is my wealth minus 2000 cash which has gone out. So overall now my wealth which is left with me is 10,000. Which means, do you agree? There is no change in your wealth. Before write it was 10 and after write also it is 10 only. Everyone, there is no change in my wealth. People, please validate if you are settled or not. Come on. Till this particular point, are you settled? Yes or no? Come on, everyone. Sir, now let's proceed ahead. Suppose what if I renounce? Which means I had 100 share, I am not buying them, I am not buying further shares, I will continue to have 100 shares only. At a price of 96, which means my wealth in terms of shares will become 9600. Agreeing you all to it? But sir, if I renounce, please understand what will happen. Against 100 share, I will have 25 rights. And one right I can sell it for rupees 16, that I know. So 25 right when sold at a price of 16 will give me 400 rupee from my friend whom I had sold the right. So 9600 is the share wealth I have, 400 rupee of cash I have received. So 10,000 is the total amount of wealth I will have even after the rights, which means if you subscribe or if you renounce, theoretically we can say that there won't be any change in your wealth. You have choices. The last is what if you ignore a right? Sir, if I have 100 shares of 96 each, I am not exercising anything, I will continue to have 100. The price in the market has become 96, my wealth in terms of shares 9600. I have not renounced anything, which means I won't receive any cash, which means my wealth will become 9600. There will be decrease in the wealth if I ignore the rights. So if you compare these three situations, what have you learnt, everyone in the class? If you compare these three situations, what have you learnt? Come on, tell me, people. Please. We have learnt that we may subscribe or we may renounce, but you should never ignore. Does that learning applies in my case as well? Now you people are obviously responding, which I appreciate, but those who are not responding, should you ever ignore? Anyone? Especially your teacher? Not really. Well, jokes apart, which is why I've particularly marked it as green thread. You exercise it, you renounce it, but you don't ignore. Yes? This completes the entire discussion and understanding of rights issue. People, how much out of 10 on this entire discussion? Come on. Is it bringing to you the needed conceptual clarity? What do you all say? Come on. Recorded people, please respond back in the form of comments, obviously, because that's the way we can communicate. Aksa, 10 on 10. So great. Let's now proceed to solve the practical questions. But before that, let us take a break of 12-15 minute break. It is 10:58 right now. Let's meet back at 11:10. Works, everyone? Let's meet back at 11:10. All right. See you all, everyone. 11:10. Then we solve the practical question, learn further things. चलिए बॉस, so are we all there? Shall we proceed ahead to solve some practical questions? Come on. People, come on. So we see that, everyone, question number 81 is really an easy question, similar to what we have done in the class. The illustration that we were just solving in the OutNotes, exactly same question, question 81 is. Similar to that is 82. So let's look at this question 82 in class. Come on, people. Yes. So Pragya Limited has issued 75,000 equity shares of rupees 10 each. Fine, sir. The current market price per share is 24. Company has planned to make a right issue of one new equity share at a premium of 60% for every 4 shares held. Read the first 2 lines again and identify what all information do you see in these 2 lines. Come on, everyone, do it. Let's try to identify what all information do we have. So first information is that I have number of share as 70,000, 75,000 and 0 is given. Face value is there. Current market price of P0 has already is also there. The company has plans to make a right issue of one new equity share for every 4 share. So 1:4 right ratio is also there. And at last, everyone, at a premium of 60%. In your understanding, they are asking to issue the right share at a premium of 60% on face value or on CMP. Premium word has both the context. One is on face value, another is on CMP. In your understanding, the issue price of right share will be 60% over CMP or 60% over face value. Think, no? On face value is what Anuka is saying. Come on, other live and recorded people. So if it would be on CMP, will anyone in the market ever buy that share? Will anyone ever buy that share if it is at CMP? No. In case of right issue, the shares are issued at a price lower than the market price. Yes. So if it is 60% of premium on face value, my issue price becomes 16 rupee, which is lower than the market price of 16, say market price of 24. Fine, done. You are required to calculate the theoretical post-right price, ex-right price. So the calculation is really easy. Existing market value plus the new market value. Existing market value is 75,000 into 24. New market value is issuing at a price of 16. How many shares? Sir, 75,000 into 1 divided by 4 shares. 75 into 1 divided by 75,000 into 1 divided by 4 is 18,750 shares to be issued at a price of 16, where 75 existing share at a price of 25 are there, divided by total number of share being 75 plus 18 is 93,750. How much is the price? 24 into 75,000 M plus 16 into 18,750 M plus memory recollect divided by 93,750 is equal to 22.4 rupee being the ex-right price. What is the theoretical value of right alone? Can anyone in the class try to answer second part, please? Come on. Can you all please try to answer the second part of this question, everyone? Sir, value of right alone means the thought process. What was the thought process? Think of the thought process. The thought process was, if you sell that share, if you sell that option to anyone, how much advantage will other party have? That is the maximum price he will pay to you. Price in the share after the right will become 22.4. The same share he can purchase at a price of 16. So 22.4 minus 16 is the maximum benefit of 6.4 rupee he will have, and that is the maximum benefit he is going to pass on to you, calling it to be everyone 6.4 per right. Cool. Value of right alone. Show the effect of right issue on the wealth of shareholder 1000 share, assuming he sells the entire right. Before solving itself, can I say for part number C, there will be no effect on the wealth? If I have 1000 shares where existing share price is 25, my wealth is 24,000. If I sell my rights, I will continue to have 1000 share where price per share will become 22.4. So 1000 multiplied by 22.4 is 22,400. But when I sell on 1000 shares, I will get how many rights? Sir, 1000 divided by 4 is 250 rights I will get, where every right is sold for 6.4 rupee. I will get 1600 rupee of cash. Right? So 1 second, there is a small presentation mismatch. Yeah. So in terms of share, my wealth is 22,400. In terms of cash, my wealth becomes 1600, which means overall wealth continue to remain same as the previous one of 24,000, and that's why the effect on wealth is nil. C part extremely easy, gets done. D part, show the effect on wealth, manageable. E. So D and E part you will have to do, everyone, at your own, are easy enough. Part number D, part number E, easy enough. 82 question gets done. 83rd is again an out of the box question. I find it difficult that even if I give that to you as challenge, you will be able to do it. 83rd question we can do in class or we can ignore. 84th question is surely to be not done. 84th question is to be not done. 83rd is something we can do in class. Come on. Shall we proceed to question number 83rd? People in the class. Aggressive Limited is proposing to fund its expansion plan of 12 crore by making right issue. I need 12 crore rupees in total. I am planning to issue the right shares. The current market price is rupee 40. Every share is being sold at 40 rupee. The board is willing to offer discount rate of 20% on CMP for the rights issue. Sir, what are they saying? Whatever is the CMP, on that we are willing to offer 20% discount rate. The board is, so if the CMP is 40, how much will be the discount? 20. So 40, everyone, minus 20% is 32. 40 minus 20% is 32. 32 is what? 32 is what? Sir, 32 is my X, 32 is my issue price. The board also desires that the fall in the exercise price should be restricted to 10% of CMP. Sir, one more thing. You have to imagine it on the timeline. Let me present it for you. This is where the right issue is happening. The price before that is 40. I am planning to issue the shares at a price of 32 and I want that immediately after issue. I know the price will decline from 40 to something, but it should not decline by more than 10%, which means the decline should be limited to 36. Of the questions that we have done so far, this particular thing was being asked. This time the particular thing has been given. Alright, fine. You are required to calculate the number of new shares to be offered for each right held. The number of new equity shares to be offered for each right held, the word actually is not correct which they have framed, but what they are asking is for the right ratio. Their correct language could have been the new equity share to be offered for each existing share. They want to ask is right ratio. Do you agree this time the question is a reverse calculation question? Hello? There are multiple ways to solve this question, but I am going to show you the one. I am going to show you the one which institute has followed. Yes, which is also logical. What the institute wants to say is that if we assume one particular share, let's assume that I have one share, right? Then can I say the new share to be issued will be 1 multiplied by whatever the right ratio is. If the right ratio is 1:2, then I will issue half share. If the right ratio is 1:4, then against this one share multiplied by 1/4, I will issue 0.25 share. Yes or no? I can assume that I have just one share. But sir, how can you assume the number of share? That is something that should be used as actual, because everything in the formula is proportionate. For example, if you assume 100,000 shares, then with the ratio of 1:4, you issue 250 new shares. However, if you assume 100 share, then with the ratio of 1:4, you issue 25 new shares. The denominator at the same time also becomes 100 plus 25. The answer will continue to remain same. Are you understanding? Based on the existing share will be the new share decided based on a ratio on proportion. So if you assume 100, you get the same answer. If you assume 1000, you get the same answer. If you assume 1, then new share issued is 0.25 and you will get the same answer of 96. Could you connect to this particular math? Everyone. Which is why, what do I say? What I'm saying? Let's assume that I have one particular share. Since the ex-right price is already given to me this time, let me apply the formula of ex-right price and figure out if I'm able to back calculate the right ratio or not. For example, ex-right price is 36. The ex-right price is equal to what? People, the ex-right price is equal to my existing wealth, one share of 40 rupees plus the share which is issued. So how many share will be issued? Sir, 1 multiplied by whatever is the right ratio. These many shares will be issued at a price of 32. Whole divided by. This is the post-right market value, existing market value plus the new market value divided by my existing number of share, and the number of shares to be issued will be 1 plus R. And using this, the X right price that I calculate should be equal to what, everyone? Should be equal to 36. Now, do you realize in this entire equation, the only number that is missing is R. The only number is missing is R. In fact, you can make it more simple. Let's say that the new number of share to be issued is R only. I have one share of 40 rupees. I am planning to issue R share of R share of 32 each, and after that I will have 1 plus R total number of share, and the X right price should not be less than 36. So whenever institute give you such reverse calculation based questions, people in the class, the approach is really simple. Try to apply the formula of what is already given. Try to apply the formulas of what's already given, and this is not what I'm saying. I'm talking about ranker specifically mentioned it. That sir, in the class you taught us one thing. What was that particular thing? The thing that whenever you have to make any kind of reverse calculation based question, whenever you have to answer any such question, you have to, sir, we remember you saying it in the class that write down the formula of the thing already given. 36 is given, write down the formula of it. And in that formula, you will find one particular number which is missing, which you need to calculate. And that's what happened in the exam of November 24, where more than 80% of the questions were reverse calculation based. No direct questions. Almost 80% question reverse calculation based. And that's where that ranker, 2 rankers gave me the same thing. That's why this particular trick worked in the exam. Are you all understanding? Now, choice is yours. What do you want to follow? If you find it sensible to follow it or not. So that way, if we do, we are able to calculate the R. Can anyone in the class please solve? Everyone in the class, do solve this and give me what are you getting R, the new shares to be issued. Come on. What are you getting as R? Come on. Do solve it. And also, while giving the answer, respond to me in the chat box. Could you connect to how is this particular equation made? Come on. So what am I getting as equation? 36 plus 36R. When I bring the entire denominator to LHS, multiplied with 36, it becomes 36 plus 36R is equal to 42 plus 32R. When it become 4 and it become 4. 4R is equal to 4 and R is equal to 1, which means against every one share that I have, how many new shares I am planning to issue? I should issue to make my price of 40 as 36 if I issue at 32. Against every one share, how many such shares I should issue? Sir, one only. And can I say in that case the ratio become 1:1? In that case, the ratio everyone in the class become 1:1. The first part question being answered. The rest of other 2 parts are really easy. The main part that I wanted to help you understand was this one, which involved some kind of reverse calculation. 83 question, that way in the class gets done. How much out of 10 are you people? Please set on this particular question. Kindly respond so that I plan the things ahead. Come on. Shall we proceed? So 83rd question gets done, 84th you don't have to do. To be able to do question 85 and onwards, you all need to now move to the next concept, people. So let us very immediately move to the concept of buyback. Have you all have heard this word called as buyback, people? Obviously, yes. Sir, when a company needs money, it issues the share. For example, when the right shares were being issued, me as a company will issue the share to you. You as a shareholder will give money to me. So what is issue? When company gives share to the shareholder and shareholder give money to the company. That is issue of share. What is buyback? The reverse process of it. Sir, this time company, rather than in need of money, want to return the money back. Company will get its share back. Company will buy its share back, and in return will give you money. I am a company, I want to give you the money back and get my shares back from you. This process is called as buyback. The price at which shares were issued was issue price. The amount I received at the time of issue is issue price. Similarly, when I get back my share, I have to pay to you a price called as buyback price. Is buyback compulsory to an investor? Can I force you to sell the share back to me, and can I pay the price to you forcefully? The answer is no. That's a choice I will give to you. That's an option I give to you, that if you want, you can buy back the shares. Just give me a second. Yes. So since I cannot bound you to participate in buyback, I will have to motivate you to do that. What is the way to motivate? Really simple. Price of the share in the market is 60. I offer to you a price of 70. That if you go to the market, you will be able to sell your share at 60. If you sell that share to me, I give this option to you, can sell it to me for 70 rupee. So 70 rupee that I will pay to you on account of buyback is called as buyback price. Yes or no, people in the class? Sir, what will be the implication of buyback? Let us try to understand. Suppose the company had 10,000 shares. Out of those 10,000 shares, on a particular day, company bought back 50 shares. After buying back, can I say, company will be left with 9,950 shares only? Because 50 shares have been opposite to issued, they have been bought back, those shares have been reversed from the books of the company. Now after buyback, whatever be the market value, whatever be the earnings of the company, whatever be the cash flows of the company, these 9,950 shares that are left with the shareholders, they will have the right over the company. Am I making sense? Now the point is, the company, when buy the shares back, will have to pay an amount to the shareholders. Where can it get that amount? In two ways. Possibility one, it already has some surplus with itself. Possibility two, it may borrow this amount from anywhere. So the amount which company borrows will be paid back, or if it already has a surplus, will be paid back to the investor. Sir, what is the implication? Implication is that in both the case, they will have a loss of interest. Assuming that company had surplus that was invested somewhere, now when it is paid back to the shareholder in the next year after the buyback, will the company be able to earn any kind of interest? No, because there is no surplus. That is the loss of interest. Imagine that rather than surplus, the company thought of borrowing the amount from debt and pay to the shareholder in the form of buyback. Do you agree on the borrowings which are made specifically for buyback? After buyback, there will be an additional interest payment that will be needed to be made. So either there is interest lost or interest paid when a buyback is funded through surplus and borrowing respectively, which will affect my future profitability. An additional cost of interest comes into picture. Everyone, could you understand it? Come on. This clarity of concept is extremely needed even to the basic concepts of rights issues or buyback. Fine, let's start. Sir, the total amount of surplus or borrowing which is used to paid back to the shareholder is called as buyback amount. The total amount I will pass on to them. The price at which I do the buyback is generally higher than the market price. I call it buyback price. So if I know that I have to pay to you 60,000 rupees in total because that is the surplus I have, and I know that the buyback is happening at a price of 60 rupee, then you can figure out, right, that how many shares will we be able to buy back. 60,000 divided by 60 gives me 1,000 shares you'll be able to buy back. So whatever number of share you had, for example 10,000, out of which is 1,000 is bought back, then post buyback shares will be left as 9,000. Pre-buyback minus the shares bought back will be the post buyback number of share, and these will be the shares which will participate in the profits of the company, value of the company, because now there are only 9,000 left for future. Yes, sir, in two possibilities you can do the calculation, one related to earnings, another related to value. We have both the category of questions. One related to value is post buyback number of share multiplied by post buyback market price is equal to post buyback market cap or market value. Can we simply say number of share into market price is market cap? Now if I want this to be post buyback, then all the parameters should be post buyback, that simple. Similarly, can I say post buyback MPS is equal to post buyback EPS into post buyback P ratio? Simple. Similarly, can I say post buyback EPS will be what? Whatever is post buyback PAT divided by post buyback number of share. Post buyback PAT, sir, will be whatever was pre buyback PAT minus the interest which got lost or which have to be paid in case of borrowing, and that too after the effect of tax. Because if my income reduces, the amount of tax also reduces, giving me to only the loss of only net amount. So post buyback PAT minus the net of tax interest divided by post buyback number of shares is post buyback EPS. I said a wrong word. Pre-buyback PAT minus interest gives me post-buyback PAT. Everyone in the class, are you all people 100% comfortable with these basic formulas? Because now if you are done with these basic formulas, you will have to go to the practical question, 85th being the first practical question we do in class. Come on. Give me a minute. Can I have water, please? Give me a minute. Kindly start to read the question, please, everyone. Yes, people. So back. Rahul has surplus cash of 100 lakh rupees. Please imagine the start of the question. Generally, whenever it is the question of right issue, how do they talk? They talk about, whenever it is a case of right issue, they talk about the need of the fund. They talk about raising it because there's an expansion or something. This time they talk about of the surplus fund which is available. They think of paying it back. Yes. So Rahul has surplus cash of rupee 100 lakhs and want to distribute 20% of it to the shareholders. Fine, sir. Great. Which means how much is the funds, by how much is the total buyback amount? 100 lakhs into 27% is 27 lakhs. Fine. The company decides to buy back shares. Fine. The finance manager estimates that the share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. If we do the buyback of share, I get my share back, I give you the money back, total 27 lakhs I pay you. Then whatever is the price today, whatever is the price at which I will buy back, I will give you that amount, whatever amount I give you on a per share basis. The price after buyback will be 10% above that price. Price after buyback will be 1.1 times of my buyback price. Fine, cool. The number of share outstanding at present is 10 lakhs. Right now I have 10 lakh shares where my EPS is rupees 3. You are required to determine. What are we required to determine? The price at which share can be repurchased if the current market cap of the company market cap of the company should be 210 after the buyback. Reverse calculation based question actually. Reverse calculation based. Come on. Not a very easy one directly to understand and process. I have been given the total buyback amount of 27 lakhs. That is fine. Second, I have been given that whatever be the buyback price, the market price after buyback will be 10% above that. Cool. Present number of share is 10 lakhs. The price at which share can be repurchased, I need to calculate. The price at which share can be repurchased, I need to calculate. Can I say in simple language, I have to calculate the buyback price? The price at which share can be bought back is nothing but buyback price. I need to calculate. If the market cap should be 210 after buyback. So I have been given the market cap of the company after buyback, and I have also been given the price of the company after buyback. After repurchase, the share price should be 10% above. After repurchase, the market cap should be 210. By linking these 2 points, you can do something. What can you do? Let me tell you. Sir, irrespective of whatever be that question, the formulas that can be used to solve any of your buyback question will be those 3-4 simple formulas used in the OutNotes, learnt in the OutNotes. Done? So I know market cap is nothing but number of share into MPS. I know market cap should be 210 after buyback, 210 lakhs. Number of share right now is 10 lakhs, but after buyback, some shares will be reduced because they will be bought back. So 10 lakhs minus some share will be the post buyback number of share multiplied by post buyback market price. If the post buyback market price, which examiners say will be 10% above the buyback price. So if I assume buyback price to be X, the market price will be 1.1x. The only thing that I need now is this particular number, the number of shares bought back. Can I say the total surplus available is 27 lakhs, which is to be distributed? If every share is bought at a price of X rupee, if every share is bought at a price of X rupee, can I say 27 lakhs divided by X give me the number of share to be bought back? 27 divided by X. And from 10 lakhs, if I deduct 27 lakhs divided by x, 27 divided by x, I get the number of share that will be left after buyback to be multiplied with the price after buyback, which is 1.1 of the buyback price, which is 1.1 of this x, and the market cap should be 210 lakhs. People in the class, how many of you are aligned to the equation that we have made? Come on. It's new to process, I can agree to, but how many of you are able to think that it is the simple equation that we have used to solve this particular question? Sir, whatever has been given, I just try to relate those things, write down an equation of it, try to put the formula and find the missing value of x. Come on. Yes or no, people? Waiting. I can re-explain. If you ask me to do it, I can re-explain. Please validate if you are able to connect to me or not on this. Yes. Now if we solve this, we are not solving it right now in the class, but if we solve it, we get the buyback price to be how much? 21.79. Buyback price to be 21.79. That x is my buyback price, the price at which I will do the buyback. Examiners say how many shares that you will buy back. So 27 lakhs divided by 21.79, sorry. 21.79 will give me the number of shares to be bought back. 27 lakhs divided by 21.79 gives me 1,23,910 shares to be bought back. 1,23,910 shares to be bought back. B part is done. See, impact on the EPS, assuming net income is same. This particular line is important. Assuming net income is same means what? Generally, when the company distributes the surplus, it creates an impact on the income. Why? Because earlier whatever income was being generated, we won't be able to generate it now, and which is why I'm saying that net income examiner is saying will continue to remain same. Sir, if I had 3 rupee of EPS for my 10 lakh shares, I will continue to have 30 lakh rupee of income. But now this income will be distributed to lesser number of share, 10 lakhs minus the shares bought back, which is 123,910. Only to the remaining number of share the income of 30 lakhs will be distributed. Sir, 30 lakhs divided by rest of the share is how much? If I do calculate, it is 3.42429, which is 3.42 rupees, the EPS after buyback. Yes. So part number B and C were obviously easy. On part number A, we had to apply some brains to figure out what should be done. Come on. Could you all understand and process what this question was? Shall we proceed ahead? This particular question, like obviously a lot of questions, almost all the questions you will have to do in the notebook, but these questions which are tricky in nature, when you write them down, they have a special effect on your preparation, because through writing them down along with understanding them, you are also able to kind of remember them. Yes, which is needed. So if 85th gets done, 86th question you won't have to do. 87th question is something we can do in class. 87th, a brilliant question, come on. The last question for the day. Everyone, 87th, let us proceed. What does it say? SM Limited has market cap of 3000 crore and the current EPS of rupee 200. I have market cap of 3000 crore, EPS is 200, P ratio is 15 times. Using the three information, can you tell me what else can you find? Market cap is there, EPS is there, P is there. Using the three information, what further things, numbers you can calculate? Please tell me. Everyone, do participate, do respond. Anuka says, sir, number of share we can calculate, MPS we can calculate. Sir, if I have EPS of 200, come on, recorded people, what are you doing? 200 EPS multiplied by 15 P ratio give me 3000 of MPS, and market cap is 3000 crore, then the number of share would be 3000 crore divided by 3000, which is 1 crore shares. Agreed? Fine. The board of directors is considering a proposal to buy back 20% of the share at a premium, which can be supported by the financials. Board of directors say, why shouldn't we buy back 20% of share at a premium? So out of 1 crore share, how many shares are we going to buy back? 0.2 crores, which is 22 lakhs. Sorry, 20 lakhs. At what premium? 20% of the share you buy at what premium? The premium which is not given, but something which can be supported by the financial statements logically, because when I have to pay that amount to you, it has an impact on my financial statements. The board expect the post buyback market price to be 3057 and post buyback PE ratio will remain same. So these information were pre-buyback. Now examiner is also giving to us post buyback information. The board expect post buyback market price to be 3057, P ratio remains same as everyone in the class 15. Post buyback market price which generally institute ask is given. After buyback, what is going to be the price? 3057. And if the P ratio is also given after buyback, can you all please tell me what else can you find using these two numbers after buyback? Come on. What else do you think, people, you can find? MPS after buyback is given, P after buyback is given. Can't I calculate EPS after buyback? 3057 divided by 15 is 203.8 rupee of EPS after buyback. Company proposes to fund the buyback by availing 8% bank loan. Sir, whatever is the amount needed for buyback, that we don't know, because 20 lakh shares will be purchased at some premium, I don't know. Whatever is the buyback amount, 20 lakhs into the buyback price, will be availed by way of 8% bank loan. Tax rate is 30%. We have to calculate the interest amount which can be paid for availing the bank loan. Come on. Soumya, why do I remember your name? Soumya, were you there in any of the previous batches? Maybe live ones. I don't know, but I remember your name somehow. Yes. So everyone in the class, let's very clearly try to understand what is question trying to ask. I give you 1 more minute. Read the entire question again. Read the entire question again, and then I proceed to explain to you what is this randomly trying to ask. Come on. So what it says, it says that how much interest can be paid for availing the bank loan. Sir, what kind of question is this? Whatever is the buyback amount, that is the amount of loan we take, multiplied by 8% will be the interest I will be ready to pay. But the buyback amount is not available. An institute is first asking the amount of interest to be paid. So actually everyone in the class, the calculation needed relates to first calculating the interest. You have to please realize they say you have to buy back 20% of the shares, which means 20 lakhs shares. Listen to me carefully, 20 lakh shares at a price, at a premium which can be supported by the financials of the company, which can be supported by the income statement of the company. Because when you buy back, for that amount you take a loan. When you take loan, you have to pay an interest. How much interest can you pay? That is what the financials will be able to tell you. Sir, now you have to learn a very important thing. I am doing a business where in the assets I have invested 1 lakh rupee, where equity has financed the 1 lakh rupee. If I raise the debt of 50,000 and use that amount to buy back equity, so that equity left in the business is also 50, my capital will continue to remain 1 lakh, just that earlier it was financed by only equity, now it got financed by equity and debt both. When I do this change in capital structure, does it affect the operation of my company? The answer is no. My machine's debtors inventory will continue to be operated in the same way. Which means if my operation doesn't get affected, will my operating profit will get affected? No. I will continue to earn the same EBIT before buyback and after buyback. Buyback will never affect my EBIT because that relates to operation, and buyback is a capital structure thing, not an operating thing. Everyone, are you able to please understand what I'm saying? Correct? So sir, after buyback, my EBIT will be same as before buyback, but after buyback, my PBT, profit before tax, will not be same as before buyback. Why? Because before buyback I have 1 lakh rupee of equity on which I don't have to pay any interest, but after buyback I have 50 lakhs of equity and 50 lakhs of debt. On this amount of debt, the interest is needed to be paid, which is by EBIT pre and post will be same, but PBT pre and post will not be same, they will be different. Could you understand this, everyone? So in terms of concepts, if I have to show to you, this is what I mean to say. Where the debt is taken to buy back the share, it affects the capital structure of the company. As a result, EBIT remains same pre and post. But PBT, pre and post buyback, are different due to the element of interest. And now let me make use of this particular small concept and show you how the question is to be solved. Let me take you to the buyback question first of all in the notes. See this question. 87th question, I have drawn it on the timeline for you people. Come on. So what's happening? If you look at the solution of this question, it's really big, huge. What we want to do is to understand this entire question in a very short manner. which is extremely easy. Sir, if I talk about pre-buyback situation, I have my income statement, EBIT, interest, PBT, tax, PAT, number of share, EPS, whatever. If I talk about post-buyback income statement, that is also there. In pre-buyback income statements, since there is no debt, there will not be any interest. However, in post-buyback income statement, since there is an element of debt, there will be some interest as well. We need to first of all find this particular number, the interest which can be supported by my financials. Since examiner has given to me all other information of pre-buyback, of post-buyback, first I need to do the reverse calculation of the interest. And that is the answer to first part of this question. Before proceeding to solve, am I able to make you people imagine what the solution is around? Come on, people. So now again look at the data examiner had given. Examiner said you have a market cap of 3000 crore. We realized the market price is 3000 because the number of shares were 1 crore, right? We knew the EPS is 200, PE is 15. PE is 15, EPS is 200, this much we were clear. We will have to do the reverse calculation to find out EBIT, because we know that the same EBIT will continue to be there even after buyback. So let's go back till EBIT. Sir, I have the EPS of the company, I have number of share of 1 crore. So 1 crore into EPS of 200 rupee give me 200 as my PAT. After tax rate of 30%, if PAT is 200 crores, so PBT is how much? So 200 crore divided by 70% will be PBT, which is 285.71 crore. And if this was PBT, in the absence of interest, can I say the same would be my EBIT? There is no interest to be paid. EBIT will be same as PBT, 285.71. And can I say it will be same EBIT even after buyback? My post-buyback EBIT will also be same, 285.7143 crores. Requesting every live and recorded people watching up this lecture, how much out of 10 are you people settled till this point? Come on. Everyone. The solution that you understand out here on timeline is easier than what you see in the form of text. Come on. People, please. So now we have the post buyback EBT. Examiner has given to me post buyback MPS, it has given to me post buyback P ratio, which means can I say I can also calculate post buyback EPS. MPS divided by P ratio is post buyback EPS. Sir, out of 1 crore share, if 20% is bought back, then I'm left with 80 lakh shares, 0.8 crores. Yes. So 203.8 being the EPS on 0.8 shares, it is 163.04 crores of PAT which will be there after the buyback. If PAT is going to be 163.04, then how much will the PBT be divided by 70%? PBT is 231.91 crores PBT. So now you look at the thing, EBIT after buyback, EBIT is going to be 285.71. After buyback, the PBT is going to be 232.91, and the difference between EBIT and PBT is the amount of interest which can be calculated. That's why we say that the interest which my financial statements will be able to support, in the sense that EBIT is going to remain this only and PBT is going to remain this only, because the information is given by the question. So how much interest can be supported is the difference between the two numbers, sir, which is 285.71 minus 232.91 is 52.8 crores, the amount of interest. Everyone, could you all Understand the point I'm trying to make here for you people. How would the presentation happen now? The way you are looking at the arrows. Sir, starting with market value, number of share, MPS, PE, EPS, then PAT, then PBT, then EBIT, then explaining to examiner that post pre-buyback PBT will be post-buyback PBT, EBIT, and then stopping here. Pre-buyback EBIT is post-buyback EBIT and stopping here. Then start your calculation this way, come to this point, and ultimately interest will be this minus this. It's that simple the presentation is going to be. Are you all, everyone in the class, aligned to what I'm saying? See, the entire thing that we did in a small table is here. This entire solution, this entire almost 2-pager solution, 1.5 to 2-pager solution is here, explaining the same thing. Once you have the interest you can afford, I know the rate of interest is 8%, so I'll get to know the loan I can afford, which is 52.8 divided by 8%. Interest rate is the loan of 660 crores. Using the total buyback amount of 660 crores, how many shares I am buying? Sir, 0.2 crores. So 660 divided by 0.2 crores give me, on a per share basis, the buyback amount, the buyback price is going to be 3300. This is the buyback price that I was needed to calculate. 3300 crore is the buyback price. So examiner had first asked the interest amount, then the loan amount, which is my buyback amount, then the premium per share. Since I will do the buyback at a price of 3300, where the price per share in the market is 3000 as we calculated, the premium that we are giving on a per share is 300 rupees or 10% of my market price. First part was difficult to crack, second and third part were relatively easy. Please tell me. Are you all there? Settled? People in the class? Are you all please? Settled? So 87th question being an ambiguous question, being a proper reverse calculation based question of buyback, we are done with, alright. 88th question, similar nature, I think you should skip. Don't do anything. Had some point of difference, but let's not enter into it. Similar question, if any question of this sort come to the exam, you already know how to solve it. 88th is done. 89th, an easy question you will have to do in homework. 89th question relate to the concept of bonus issue is homework. 88th you don't do. 87th we have done. If you feel like doing one more question in homework, you may do 86. If you feel like doing one more question in homework, you may do 86. Right? 85th we have done in the class. 84th not to be done. 83rd already done in the class. 82nd done in the class. 81st was homework and so on. Yes. So this people completes the entire discussion on chapter number 1, which was equity and business valuation, such a huge chapter completing all its concepts, all its questions. And the last thing which is yet to be done is the bonus issue. The last homework question relates to bonus. Their theory is here. You will have to read it at your own. Extremely easy theory. All right, people. So yes, that was all from my side on this. So yeah, let's meet back again in the next lecture for the next chapter, which will be mergers and acquisition. All right. I am all there from my side for you people right now. If you have any doubts, confusions, you may please ask. If no, we will call it a day. Anuka, I'll talk to the team. They should get in touch with you to, do one thing. To make you people understand the softwares and everything. And mostly we're going to take the classes from tomorrow on the application. Alright. So yes, that was all from my side for the day. Thank you so much everyone for watching up this lecture. I really hope the purpose, your purpose of attending the power batch is getting solved. You are learning the concept, you are solving the question, you are getting the confidence on how to think towards AFM. Yes? So bye bye people. Thank you so much. Let's meet back again tomorrow in the next lecture. See you all. Bye Aska. Bye Soumya. Bye Anuka. Everyone in the class. Bye bye people. Take care. I'll see you all. Bye. All the recorded people, thank you so much for watching up this lecture. I'll see you everyone.